Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
We're going to hear about two shareholder-friendly companies this time around. From our strategists who are going to fill in the blanks for us, Dan LeBeau, who joins me here at the desk, and Dave Boren, who joins us via Skype from the West Coast. Dan, we're going to start with you. The multifaceted company of Disney is what you're looking at.
Yeah, so Disney, trying to dip their hand in everything, it seems like nowadays, has unfortunately lost 25% of their value over the last month due to this coronavirus concern.
Mostly on the park side.
Yeah, so a lot of it's associated with concerns over their parks, which is a significant portion of their revenue and operating income. So it makes up about 58% of their operating income, and they had to shut down both the Shanghai and the Hong Kong parks. Due to obviously the widespread outbreak in China.
Yeah.
And people are concerned that this is going to be more widespread and they have to shut down parks across the world. So in my thoughts, this is just a short-term issue. I mean, once the coronavirus blows over and vaccines are made, this is just going to be like anything else, like the bubonic plague was 20 years ago, obviously, or not 20 years ago, hundreds of years ago. And obviously,
Glad you're optimistic, Dan, because everybody else predicting a year and a half. So
yeah, I mean it's going to blow over. SARS all of a sudden disappeared, in the middle of summer of 2013 or 2003.
The weather upcoming summer season may help.
So it could, yeah. And I think it's a short-term issue, but I mean the real catalyst for a buy in Disney right now is Disney Plus. And the company's transition to this direct-to-consumer platform, competing with Netflix, and they've gained a tremendous amount of traction. In the first 24 hours of its release, it gained 10 million customers. And by the end of last year, 2019, it already had 26.5 million subscribers, which is massive considering it's only been on the market for 2.5 months at that point.
Right.
So they just recently had a change in hierarchy with Bob Chapek taking the helm as the new CEO. He's been with the company for 27 years and has actually been the head of the Parks Experience and Products Division for the last 5. So I think this is the guy that we want at the helm right now, considering that our biggest concern is the parks. But like I said, I think the biggest catalyst is going to be Disney Plus moving forward. The company transitioned using both the acquisition of 21st Century Fox to broaden their library, and I think they're going to be a huge competitor to Netflix as well as other platforms like Amazon Prime's video platform and all the other ones that are coming out. So looking at this chart here, you can see that Disney has used the $100 level as a support for the last 3 years, and we are coming down on that right now. Trading at 105. I think buying at $1 or $100 a share would be a very savvy purchase, and I think there's a lot of upside to this company moving forward.
And did I just read correctly? They increased a dividend?
I'm honestly not sure.
Okay, I thought
percentage-wise, it definitely is true because of the stock price drop, but I'm not sure.
Okay, I thought that's what I read, but I just not gonna. Don't quote me on that. Whatever you do, Dave. We're gonna go to you now. You're gonna take a look at Dick's Sporting Goods. They did increase their dividend lately.
Yeah, Terry, I am. So Dick's has been around since 1948, when the founder Dick Stack borrowed $300 from relatives to open a sporting goods retail store that was aimed first at fishermen. Today, it's a public company with a market cap of $3 billion, and it's still run by Stack's son, the current CEO, Ed Stack. So it's maybe the nation's largest, family business. 2 years ago, Stack and the company took a somewhat unprecedented step in significantly curtailing the sale of firearms and ammunition after a wave of mass shootings. They took a big write-down on inventory at the time, and they even destroyed some merchandise rather than have it fall into other hands through discount sales or the like. So we hear a lot about big institutional investors getting interested in ESG investing these days. But Dick's was actually sort of socially responsible before socially responsible was even cool. After that move, they actually found that profitability went up because they were able to repurpose that retail space with much higher margin items. The firearms items used to compete directly with Walmart, and the price competition meant that margins were quite low. So they turned that space into a much bigger winner. Same time, they also developed several in-house brands of activewear and fitness products. They have popular celebrity endorsements, and those products sell right alongside Nike and Adidas items, big internationally known brands that are very popular with customers, but at lower prices and higher margins for Dick's. So they've got a really nice mix of product available for consumers that still allow them to hold pretty good gross margins. Just this morning, Dick's posted the latest in a long string of earnings beats when they announced that they netted $1.32 a share last quarter versus the Zacks consensus estimate of $1.21. Total revenues and same-store sales both increased by similar amounts and were highlighted by e-commerce sales, which increased by a whopping 15%. So that's a much more profitable way for a retailer to sell is through the internet. So seeing those internet sales, e-commerce sales go up is a great sign. Management raised full year 2020 guidance to a range of $3.60 to $4 a share. And they also explained that the low end of that range already reflects potential supply chain disruptions from the coronavirus. So the worst case scenario is still $3.60 a share. Prior to this morning, the consensus estimate for 2020 was $3.60. So even if the coronavirus works out to be sort of the worst case for Dick's, they're going to at least match the current estimate and likely get a lot higher. They also announced that they'd be discontinuing firearm sales at a number more stores, so that's very popular. Basically, Dick's is a very well-managed company. They anticipate consumer trends. They're willing to make aggressive moves to attract customers and support margins in a retail business where discounting often significantly harms profitability. So right now, they're going to sell guns in 440 less stores starting, I believe, immediately. So even after today's rally, Dick's shares are down about 25%, but roughly the same as Disney, below the recent coronavirus highs, our pre-coronavirus highs. They have a forward PE now of just 9 times, and they pay a dividend yield of 3.2%, even when government bonds yield just a tiny fraction of that. So if someone's looking for an opportunity to buy something on the dip, pick up a great company at a great discount, I think Dick's is your top stock of this week.
All right. Do you own either of these two stocks, Dave?
I don't personally, Terry, no.
All right. And how about you, Dan?
I own Disney, yeah.
In your personal portfolio?
Yes.
All right. Thank you for that, both of you. And don't forget, there's a ton more stock information on our website, Zacks.com. Get on over and start checking it out. There's a lot to go through and digest there. And don't forget also that you can get advance notice of positive earnings surprises. Zacks Research Breakthrough predicting with about 80% accuracy which stocks are going to beat earnings expectations even before their earnings reports are released. In order to get full details on this offer, go to Zacks.com/promo. With Dan and Dave, I'm Terry Ruffalo.